Most startups don't fail because the idea is bad. They fail because they run out of cash, and that happens when founders don't understand one number called burn rate. In this video, I'll show you exactly what burn rate really means, how to calculate it correctly with a real example, how it affects your runway, and why investors track it so closely. If you want control over your startup cash, don't skip this. What burn rate really means and why it matters. Burn rate simply means how much cash your startup spends every month. It is not about profit, it is about survival. Many founders confuse revenue, profit, and cash flow, but burn rate is different. You can have revenue and still burn cash. Startups fail not because they are bad ideas, but because they run out of cash. That is why burn rate matters more than profit in early stages. There are two types of burn rate. Gross burn is your total monthly expenses. Net burn is your expenses minus revenue. If you spend $50,000 a month and earn $20,000, your net burn is $30,000. Both numbers matter. Gross burn shows how heavy your cost structure is. Net burn shows how fast your cash is shrinking. Burn rate directly connects to runway. Runway means how many months your startup can survive with current cash. If you have $300,000 and burn $30,000 per month, you have 10 months of runway. This number is more important than valuation because valuation does not pay bills. Founders must track burn monthly, not yearly, because cash problems appear slowly and then suddenly. How to calculate burn rate correctly? Calculating burn rate is simple, but many founders do it wrong. Start by listing all monthly expenses. Fixed costs include salaries, office rent, software subscriptions, insurance, and cloud tools. Variable costs include marketing ads, freelancers, logistics, and commissions. One-time expenses like equipment or legal fees should be separated so they do not distort monthly burn. Founder salary must be included. Ignoring it gives a fake picture. Small expenses matter too. Multiple $10 subscriptions silently increase burn. Marketing spend is one of the fastest ways burn rate grows without notice. Hiring too early also increases burn before revenue can support it. To calculate burn rate correctly, start by tracking how much cash your startup actually spends each month. For example, imagine a startup begins the month with $100,000 in the bank. During the month, it spends $35,000 on salaries, rent, software, and marketing. By the end of the month, the bank balance is $65,000. This means the monthly burn rate is $35,000. If the startup earns $10,000 in revenue during that month, the net burn rate becomes $25,000. This simple method gives founders a realistic view of cash usage. Burn should be reviewed monthly. This discipline helps founders stay realistic and avoid surprises. How burn rate connects to runway, investors, and funding. Burn rate directly determines how long your startup can survive. This is where runway becomes critical. Runway means the number of months your business can continue operating before cash runs out. It is calculated by dividing available cash by monthly net burn. A startup with 12 months of runway is considered stable, while one with less than 6 months becomes risky. Investors pay close attention to burn rate because it shows discipline and planning. They want to know how efficiently you use capital, not just how fast you grow. A startup burning cash without clear progress raises red flags. Healthy burn supports measurable growth such as users, revenue, or product development. Reckless burn increases costs without results. Burn behavior changes by stage. Pre-revenue startups must control gross burn tightly because there is no income to offset expenses. Post-revenue startups focus on reducing net burn by improving margins and efficiency. Bootstrap startups usually maintain lower burn due to limited cash, while venture-backed startups may burn faster but must show momentum. Burn rate also affects fundraising timing. Founders should raise capital when runway is strong, not when cash is almost gone. Startups that understand their burn rate, negotiate better, and avoid panic-driven decisions that hurt long-term value. Controlling and reducing burn without hurting growth. Reducing burn rate does not mean stopping growth. It means spending smarter. Many startups fail because they cut the wrong costs at the wrong time. The goal is to remove waste, not momentum. Start by reviewing all recurring expenses. Cancel tools that are rarely used. Consolidate software where possible. Small monthly subscriptions often add up to thousands of dollars each year without founders noticing. Hiring is another major burn driver. Hiring too early increases fixed costs before revenue can support them. Instead, delay full-time hires and use contractors when flexibility is needed. Marketing spend should always be tracked against results. If ads are not producing customers or measurable traction, they are increasing burn without value. Some expenses should never be cut first. Core team members, product quality, and customer support protect long-term growth. Cutting these areas may reduce burn short-term but damages the business later. To extend runway during tough market conditions, founders should delay non-essential projects, renegotiate vendor contracts, and focus on faster cash collection. Warning signs of an unhealthy burn rate include shrinking runway, rising expenses without growth, and repeated emergency funding needs. Regular monthly burn reviews help founders stay in control and make proactive decisions instead of reacting under pressure. Burn rate as a founder's decision-making tool. Burn rate is not just an accounting number, it is a leadership tool. Founders who understand their burn rate make better decisions because they know their limits. When you clearly track gross burn, net burn, and runway, you stop operating on assumptions and start operating on facts. This awareness changes how you plan hiring, pricing, product launches, and fundraising. Strong burn discipline creates confidence. It helps founders stay calm during slow months and aggressive during growth opportunities. Instead of guessing how long cash will last, you know exactly how many months you have and what actions increase or reduce risk. This clarity improves long-term thinking and prevents panic-driven decisions. Burn rate also improves communication. When founders can explain their burn clearly, investors, partners, and team members trust their leadership more. It shows control, planning, and financial maturity. Startups that fail often had good ideas but poor cash awareness. The most important takeaway is this: cash is oxygen for your startup. Burn rate measures how fast you are using that oxygen. Growth without burn control leads to shutdown. Burn control without growth leads to stagnation. Sustainable startups balance both. Founders who master burn rate protect their company, their team, and their future. If you found this video helpful, then like, share, and subscribe for more practical startup finance and business education content.